The COVID-19 pandemic has caused global anxiety and uncertainty, affecting the economic outlook and the prospects of monetary policy normalization. In this section, we will explore how the pandemic has disrupted the global economy and what challenges it poses for central banks. The pandemic has led to unprecedented disruptions in supply, demand, and productivity, which have had cataclysmic health, social, and economic implications across the globe. According to the International Monetary Fund (IMF), the global economy is projected to grow 5.9% in 2021 and 4.9% in 2022, 0.1 percentage point lower for 2021 than in the July forecast. The downward revision for 2021 reflects a downgrade for advanced economies, in part due to supply disruptions, and for low-income developing countries, largely due to worsening pandemic dynamics. The pandemic has also increased uncertainty about how quickly it can be overcome and what its long-term effects will be. The World Uncertainty Index, a quarterly measure of global economic and policy uncertainty covering 143 countries, shows that although uncertainty has come down by about 60% from the peak observed at the onset of the COVID-19 pandemic in the first quarter of 2020, it remains about 50% above its historical average during the 1996 to 2010 period. Uncertainty has negative effects on economic activity, as it reduces consumer confidence, business investment, and trade. It also complicates the task of monetary policy, which aims to stabilize inflation and output. The pandemic has created a trade-off between supporting the recovery and containing inflationary pressures. As restrictions are relaxed, demand has accelerated, but supply has been slower to respond. This has resulted in higher inflation in some countries, especially in the United States and some emerging market economies. However, inflation is expected to subside in most countries in 2022 as supply bottlenecks ease and demand normalizes. The pandemic has also widened the gaps in expected recoveries across economy groups, with vaccine access and early policy support being the principal drivers of the divergences. Advanced economies have been able to provide more fiscal stimulus and faster vaccination than emerging market and developing economies, which face more limited policy space and higher debt levels. The IMF estimates that by 2024, the cumulative loss in per capita income relative to pre-pandemic projections will be 11% in advanced economies, compared with 20% in emerging market and developing economies, excluding China, and close to 30% in low-income developing countries. These divergences have implications for monetary policy normalization, which refers to the process of gradually withdrawing the extraordinary stimulus measures that were implemented during the crisis. Normalization is expected to vary across countries depending on their economic conditions and inflation outlooks. Some advanced economies, such as the United States and Canada, have already started or signaled their intention to start tapering their asset purchases, while others, such as the Euro area and Japan, are likely to maintain their accommodative stance for longer. Emerging market and developing economies face more challenges in normalizing their monetary policy, as they have to balance the risks of overheating their economies or losing competitiveness against those of triggering capital outflows or financial instability. In conclusion, the COVID-19 pandemic has caused global anxiety and uncertainty, affecting the economic outlook and the prospects of monetary policy normalization. The pandemic has disrupted the global economy and created a trade-off between supporting the recovery and containing inflationary pressures. It has also widened the gaps in expected recoveries across economy groups, with implications for monetary policy normalization. The path of normalization will depend on how quickly the pandemic can be overcome and how effectively policymakers can address its challenges.